All right, we're taking your questions today. So this is your opportunity to ask me anything. This will most likely be our last stream for the year. So if you have any questions, just drop it in the comments. I have a whole list of stuff that you guys have sent me on the various platforms: Instagram, TikTok, and YouTube. So whatever your questions are, drop it in the comments. And if you want me to expand on any of the answers I provide in this session, again, drop it in the comments. Let me know where you're watching from. I'm going to be in Cape Town next week seeing clients, not new clients, only old clients. So if you're not in Durban and you need some help, you're going to have to book an appointment and become a client before we sit face to face, one on one, that is. We will sit face to face online, but just not in person. In person appointments are only for clients. All right, so I'm taking your questions. The first question is it okay taking a live cover over the phone or on the internet without medical tests? Now, there's nothing wrong with it. It is available in South Africa. What's different between the two types of covers, where you have upfront underwriting and at the point of claim underwriting? So, upfront underwriting is always cheaper. And as retail consumers or policy holders, you always want the cheaper premium. So, if you're looking for cheaper premiums, you always want to be underwritten upfront. And being underwritten upfront also gives you some kind of certainty as well, knowing that there's full disclosure with the company. They know whether there's something wrong in terms of your health. They know your hereditary history. They basically know everything. So the chances of them not paying are really, really low, because the chances of non-disclosure is low, because hopefully you tell them everything, right? When you choose not to take life cover up, the medical underwriting up front, you kind of defaulting it a point of claim. So in some cases, maybe your sugar level is raised and you're at a pre-diabetic stage. You haven't been diagnosed yet, and there you are on the phone or online, and you're saying, "No, I don't have any issues with my sugar levels." And then somehow at claim stage, it comes to find out that, you know what, your sugar levels were raised for a certain time. I don't know how they come up with these things. Maybe they're doing blood tests at the point of claim. But if that does happen, there's the potential for non-disclosure, and then when there's non-disclosure, there's potential not to be paid. So do your underwriting upfront and enjoy the premiums, the cheaper premiums, as opposed to not having any underwriting done. I know the banks do this; they don't offer you any underwriting, and sometimes the pricing is very competitive. But know the risks that come with not getting your medicals not being done upfront. All right, yeah. So tap up your messages, tap up your questions in the comments, and I'll get to them. Second question: investing for income. What is the best shares for this? Okay, so if you want to invest for income, you don't solely have to look at shares. You have other options available to you as well, such as unit trusts. So when you invest for income, you got to understand the various types of income that we have in South Africa. Firstly, we have your salaried income. That's your earned income. You're trading your time for rands here. You go to work every day, you do your work, you come back home 5 o'clock or whatever time you knock off, that's it. You're not doing any more work. That's earned income. Earned income is taxed from the personal tax table, which is a very painful table, because that tax table goes all the way up to 45%. Now, it's not 100%, 45% that you're giving away to the government. It is sort of tiered, but still 45%, that's a painful, it's still a painful amount to work with. It's quite a huge chunk that's going away to the government. So earned income, uh, everybody's looking for it. I don't know why, but it's a very, very poor form of income, because you're trading your time for rands. Mainly because time is worth far more than money. And to prove my point, if I had to give you $1 million, because a million rand is not worth much, if I had to give you $1 million today and tell you at 8 p.m. tonight you have to end it all, uh, $1 million won't be worth much, right? Your time is far more important. So trading your time for rands, that's not the best. Essentially, if that's where you are and that's your only form of income, you have to be taking that income and investing into other options that pay you different sorts of income, where the tax treatment is different. Another form of income that you get in South Africa is rental income, and everybody's looking for that rental income. It's one better because It's passive in nature. You're not working for this income. You have your back room, you have your holiday apartment, whatever the case is, and you're letting it out. The problem with that is if that property is on your personal name, that means after the various deductions, then again you're taxed on your personal income tax table. Another form of income is interest income, which is great because it's passive. It's great because it's passive, and it's not great because, again, you're taxed on your personal income tax table. There is that exemption if you're under 65 of 23,500 and some change. That's your tax-free income for the financial year, right? So different forms of income. So when you're investing, you want to get better forms of income. And the income that you're looking for, the first layer of income you're looking for is dividend income. Dividend income is great in South Africa, mainly because of the tax rate. Now, when you receive dividends from South African investments, South African unit trusts, investing in South African shares, then your dividend income tax rate is only 20%. Right, it's your dividend withholding tax, whatever platform you receiving your dividends on, that asset manager is paying the taxes on your behalf before the dividend even hits your account, which is really great from an admin perspective. Every year you get your tax certificate, you'll upload it to SARS. Pretty simple. So it's just that in your head, the dividend that you get, it's an after tax amount. You're okay. The next layer of income that you're looking for in terms of investments would be capital gains income. I think that's the sweetest income. I've been doing some research on this, and I found that the richest 1%, that's where they get their income from, where they're selling businesses, they're selling property outside of their residential property, and they're triggering capital gains income, right? They're selling shares, selling unit trusts, etc. So basically, buy low, sell high, and whatever that difference is, that's your gain, and you're taxed as a capital gain. The first 40,000 Rand of capital gain in South Africa is tax free on your natural person. Then only 40% of your gain is then included for tax calculation purposes. It's not a 40% tax. All right. Um, yeah. So that's the different forms of income. So if you want to invest for income, can't tell you which shares you're going to invest in. You got to do the work. If you're not willing to do the work, go and see a financial advisor. If you don't have a financial advisor, the good news is I am a financial advisor. You can book a complimentary appointment on my website at solomonwealth.co.za. Okay. Can you tell me which company offers whole of life insurance policy? The one you are able to borrow from it, and it has a cash value and so on in South Africa. Now, many of you are watching American content creators, and America has this nice system where you can take a $5 million policy and you can borrow from it. We do not have that in South Africa. I did do a long video on it on my YouTube channel, Financially Fabulous Females. All right. So we don't have that ability in South Africa where you can take a 1 million life cover and extract 500 or 800,000 from that. That's just not possible. Previously, as in way back when, there was universal policies, and there's a few older policy holders that are sitting with these universal policies where there's an investment component to your life cover, and you are able to extract that investment component out tax-free. Those universal policies are no longer available in South Africa. Now, there are some caveats around that where there's a similar sort of benefits, but it's not a cash value benefit. For example, there's a company in South Africa that allows you to buy a portion of your life cover to fund your retirement tax-free, right? That's a really nice benefit. However, pre-retirement, you can't have access to that money. So there are those caveats. Be sure to look out on that video, cash value life cover video on my YouTube channel, Financially Fabulous Females. All right, so I see some questions. Let me go through and have a look. Maybe if you have any questions regarding finance from a South African perspective, just type it up on the platform that you're watching and I'll answer it. How long does it take to build a good credit score? Huh. I work on the wealth side of finance. I'm honestly not sure. I would assume it could be anywhere from 6 to 8 months, but I think there are credit coaches that actually work with you with this. Uh, so I don't really work with debt and that kind of thing. So when it comes to debt counseling and things like that, it's a different sort of licensing, different kind of regulation, and it's not something I want to get into. All right. TikTok, what questions do you have for me? Strangely, TikTok is quiet today. How do I set up an appointment with you? Okay, you can get a complimentary appointment. You can go to my website. It's www.solomonwealth.co.za. On the top right hand corner, you will see a bright yellow button that says Get Started. You click on that button and you will be taken to my calendar where you can book a complimentary appointment. Now, it is the end of the year. Um, there might not be any appointments available for 2025, and my 2026 calendar is not open yet. We are open to our current clientele, though. So if my current client wants an appointment, you can book one. Okay, sorry, off topic. Do you do personal consultation regarding business income? Yes, part of my licensing is I have a license to give you advice from a business perspective regarding your business income, how to structure it for wealth building within your business, and also business succession as well. So again, just book that appointment on my website. Okay, I think that's it. All right, YouTube, nothing. All right, the next question. I have a tax-free investment. What should I invest in next? Okay, I think that's a very important question. A lot of people tend to invest in their tax-free investment last, and they tend to use the tax-free investment as a kind of like a slush fund or savings account where you put money in there and then you take it out, and you put money in there and you take it out. Don't do that. All right. So, how ideally you should use your tax-free investment. Now, if you're somebody in your 20s and your 30s, you've got to see your tax-free investment as your retirement solution, right? That's your first RA. So you should see it as an RA, meaning you must be disciplined enough not to touch. You must be disciplined enough to contribute. Um, yeah, those are the two disciplines you need with your tax-free investment. Why you want to see it as an RA? Because the growth that happens within a tax-free investment is tax-free, okay, which is just like an RA. However, the access on a tax-free investment is not limited like an RA, where an RA says a minimum age 55. A tax-free investment you can access at any time. Another reason why you should see that tax-free investment as an RA and as part of your retirement stack is because you're not limited as to what you can invest inside that tax-free investment like you are with a retirement annuity. A retirement annuity tells you can't have more than 75% in equities. You can't have more than 45% offshore. You don't have those limits with tax-free investment. What that basically means is that you have the potential to grow this into something really, really big. So if you're a parent, grandparent watching this video, you would want this tax-free investment for your child. Maximum contribution is 36 a year and 500,000 Rand per lifetime. Now, I see comments online saying that if I contribute to my child's tax-free investment, I'm utilizing their allocation of 500. Yes, you are, and that's the benefit of it. But the even greater benefit is you're giving them extended time in the market. Why wait for them to go and work and study and then start contributing at 25, 27, when you can start them off at 3 or 4 and give them a 20-year head start on compounding? Remember, the contribution limit is 500,000 per lifetime, but there's no cap on the growth that can happen in a tax-free investment, right? You want to give your child whatever head start that you can. It's a big bad world, all right? And that tax-free investment is a great starter. And even if it's not something you can contribute on a regular basis, save a 5 grand, put it in there, forget about it, because it can compound over time. It's better than nothing, right? Five grand compounded is a lot better than nothing. Yeah, tax-free investment. So the only limit you have with the tax-free investment, and I think is a little bit of a downer considering gold and platinum prices and oil prices, is commodities. You can't get access commodities within a tax-free investment, and you can't get hedge funds within a tax-free investment. I don't know why. I hope they change the rules, but those are the two things that you can't get within a tax-free investment. But see it as part of your retirement stack, and you must have strategy ahead behind that. You can't just products are not solutions, right? It's strategy that drives those products to meet your financial goals and your financial needs, and that's when an advisor comes in. Um, so you need a strategy. So like in your early years, you want to be in a hyper growth strategy, taking lots of risks. And as you approach retirement, you want to be more conservative. And then you want to go into an income strategy where you're getting tax-free income from your tax-free investment without even touching the capital, right? You got to know the markets. You got to have a strategy on how you can literally retire solely. Your tax-free investment, if you start early enough, can be your major funder during retirement, and the crumbs that you get from your pension, because the pension doesn't really grow that much because of that strangle of regulation 28, that can be the sweetness, paying for your holidays and things like that, where your tax-free investment is paying medical aid, paying lights and water. Okay, what do you mean 500,000 per lifetime? So the government tells us that you can't contribute more than 500,000 in your whole life to one tax-free investment, or collectively if you have multiple tax-free investments. Why? Because they don't want the rich dumping all their money in there and getting all those tax-free gains, right? But they want to encourage regular South Africans to try and save somewhat and incentivize you by not charging you any taxes, right? So it'll take you, if you're contributing to one tax-free investment, 36,000 Rand a year, maximum 3,000 Rand a month, just over 14 years to reach that 500,000, right? You can't contribute more than that. If you do, the contribution over that allocation is taxed at 40%. Right, in your early years, you could probably get away with it because the growth within the tax-free investment will be far more beneficial in the long term than paying the 40% tax. But this is not financial advice; it's financial education. Remember, as an advisor, I'm all about strategy, but I'm not your advisor. Not if you haven't signed an agreement with me. So you can't take anything you hear on my videos and implement it. All right, so type up your questions. I will answer them. Can't we strategize yourselves? Of course, you can strategize yourself. You don't need an advisor to invest. You must be willing to do the work, understand taxes, understand the rules, understand the various platforms, understand exit strategies, and you can do it yourself. Not everybody has the time to go and learn everything about finance. And then they come see people like us. And you can't strategize yourself. You can't get all the products without an advisor. At what age can one start an RA? As soon as the child's birth certificate is issued, you can start an RA. Right? You don't even need a tax number. You can start. Can you do 500K at once for the tax-free investment? No, you can't. All right. There's multiple limits for the contribution of the tax-free. The first one is a maximum 36,000. So you can do a 36 lump sum per financial year, working up to that 500,000. You can't contribute more. Well, you can, but you'll be penalized. Like I said, 40%, anything over 36 per year. You joined. Thanks for joining. All right. Okay. All right. Next question. Oh, yeah. I didn't even answer that question. I'm sorry. I have a tax-free investment. What should I invest in next? Right. So once you max out your 36,000 Rand for the year, what should you invest in? Well, what you should invest in depends on a number of things. For example, how far away are you from retirement? What's your shortfall in your retirement planning? Do you have to catch up there? Are you on track? Are you ahead? And knowing the answer to all those questions will help determine what it is that you should invest in next. One thing that I like all my clients to have is an endowment policy, right? Now, there's some really ugly endowment policies that advisors sell because the commissions are good, but it's not the best thing for the client. So you got to do some homework here, and you can't get an endowment without an advisor for those that want to strategize on their own. Why I like an endowment for every South African, because an endowment is something that kind of stays outside of your estate when you pass away. which means the ownership of the endowment can change, which is great for wealth transfer. So if you have an endowment and you want to pass on some wealth outside of your estate, you can do it within an endowment. However, there's some tax rules that you got to understand around that. So use a financial advisor. Yeah, so that's very sweet. The next thing about the endowment you got to know is the various rules in terms of access. Now, the first 5 years is the painful part. Okay, you can't access anything in the first 5 years. And when it comes to the contributions, you can't contribute more than 120%. It's like 120% rule. So if you put in 100, you can't contribute more than 20% in the next year. All right, so that's the rule on that. So the next 5 years, after you've done your 5 year stint, your first 5 years, then you can access the policy as and when. But again, you should see this as part of your retirement stack, because the taxes within an endowment happen inside the product. So it's a tax neutral product. So the asset manager pays it on your behalf to SARS. Again, you get your tax certificate at the end of the year. So when you withdraw from that, it's an after tax amount, meaning you won't be taxed on that again. So really great as a retirement income, and the bonus of estate planning, right? Where the ownership of the policy will can pass without breaking that pot, which is very powerful. Unlike your tax-free investment, when you pass away, your tax-free investment will flow into your estate, and then you pay your death taxes, your estate taxes on that amount. So you got to make sure that you have enough in your estate in terms of liquidity. Otherwise, you're going to sell your stuff and your heirs might not end up with much. How do insurance policy premiums increase every year? My premium increases by so much, but my cover amount does not. Help me understand. So there's two components when it comes to your insurance premiums that increase every year. Firstly, it's the benefit increase, where you have 1 million and then you have a 5% benefit increase, then you have 1,050,000, and then that compounds by 5% every year. Then you have the premium increase, we say another 5%. So the premium increases every year by 5%, bringing the total increase to the policy premium to 10% a year. All right, because 1,000 Rand premium this year is that value has to come across because of inflation, because the company needs to make a profit as well. So your contribution increase and your policy increase, those are the two components that come together to make up your increase every year. So that is why you'll see a 10% increase in premium, but it's not a 10% increase in your cover. It's only 5% because of those two components. Right. And the next thing you got to know about policy premiums is the premium patterns, because that also affects it. Because in some cases, you have a fixed 5% increase on your benefit. Excuse me. In some cases, you have a 3%. Some cases, you have a 0%. Then you'll have the clever buggers that go about using an age-rated premium. So if you have an age-rated policy, please go pull this out and check. Thank you. I will drink water. I have it right here. So go and check that you don't have an age-rated premium. Or if you do, you have the flexibility to switch out as you age. So the age-rated premium gives you a really cheap premium when you're younger, which is great, because I mean your earning capacity when you're younger is not as great as you age and mature in your career. But the problem is when you're stuck in that age-rated premium and you go into your 40s and you go into your 50s and 60s, those annual jumps in premium hikes are much higher, because now with age your risk is higher. So those premium increases go from 7% to 8% to 12% year upon year. You can see how this is compounding the premium and making it unaffordable for you. And you don't want to be in a position where you've been paying for life cover for 10, 15 years and now it's unaffordable, right? If you are in an age-rated premium, make sure that the company that you would has the ability to switch out of a more level premium pattern, where you have the ability to control those premium increases. Maybe it's a 0% or 3% or 5%, but it keeps it within your budget and you're not canceling the cover. All right. I have a nice question here. I'm going to read it out to you. I'll come to the question now. Did I miss anything else? All right. So the question is, I am owing SARS money because I received interest on my savings. What should I do to avoid this? I already have a tax reinvestment. All right. So the answer to that question was in the first part of this video, where I explained about the different qualities of income, on how you get the income and the tax treatment on that. We said that interest is a poor quality of income because it's taxed on the tax table. There is that caveat there of 23,450 rand some change. So how to avoid being double taxed? Because remember that interest income is a compounding tax year after year if you don't switch out of interest income to a better quality income like dividends or capital gains. So how should you should what you should do to avoid this? Firstly, you want to sit with a financial advisor that will understand your unique circumstance, understand your need for income, and the various risks that you can take, because you can't take all of this interest bearing money and put it into something high risk if it doesn't match you, right? Maybe there's an investment wrapper you can wrap it around, but still have interest, but being taxed at a lower rate. For example, if you are sitting on a 45% tax bracket, right, and your interest is just pushing you up to that 45% tax bracket, but you can't handle the risk of an equity market, I would use an investment wrapper that shields you at a capped 30% tax rate rather than 45. Right? Again, strategies, products are not solutions. You need strategies to come up with this. So I recommend you sit with an advisor, understand all your income needs, the kind of risk that you want to take, and from there, break up that pot into various levels of investments, looking at taxes as well. You guys want to get onto my stream? I don't even know how to invite somebody on my stream, so please don't invite yourselves. All right. Next question. My retirement value is worth less than what I put in. How can that be? Okay. So there's different types of financial services providers in South Africa. So the first thing you got to consider when you when you're taking a retirement annuity is the type of provider you're selecting. Are you selecting a life provider or a pure asset manager? I tend to find that life providers have extremely high fees when it comes to the retirement annuities, and that's not where you want to be. And the life providers also seem to be very rigid. For example, you can't, if you're having a bad couple of months and tight couple of months, instead of pausing your RA premium, they're going to charge you from some huge penalties to pause it. Whereas if you were the pure asset manager, you can pause it at any time, start it at any time, do a lump sum in there at any time, drop the premium from 10,000 a month to 1,000 a month at any time and bring it back up again. That's the kind of flexibility an asset manager gives you as opposed to the life company. So if your retirement value is worth less than you put in, one, it could be the fees, and life companies to give you some fees. Next could be what you are investing inside that portfolio. Now, this is where an investment strategy comes into play. Depending on where you are on your journey, how close you are to retirement, you will have an appropriate investment strategy in place. All right. Different kinds of asset classes perform differently. This year was a little bit of a topsy-turvy year when it came to equities because equities were in the bloodbath in the first 6 months of 2025, especially with Liberation Day and Trump coming in and all of that. Then it went into a little bit of a surge. We saw China go up and down, but we saw emerging markets just flourish. We saw ups and downs in the crypto, but we saw gold just skyrocket and just drop just a little bit, but still at all-time highs. So all of those various asset classes perform differently. And again, you got to figure out your strategy within those asset classes to try and meet you at your risk level, to see what kind of returns you want and the kind of risk appetite you want to put into your retirement annuity. So you got to go in. If your returns are not looking good, you got to go in and try to understand what your strategy is. If you don't know how to do that, speak to your advisor. All right, I see some questions on TikTok. Let's go to that. Remember, if you have any questions, you can type it out on the platform that you're watching and I will answer them. Can a family trust open a tax-free investment if I am a trustee and my kids are the beneficiaries? No. So a tax-free investment is only for the natural person, right? So you want to keep it linked to your tax number. A trust can't hold a tax-free investment, unfortunately. Um, Businesses can't have a tax-free investment. Trusts can't have a tax-free investment. It has to be linked to a person, because when that person passes, it flows into an asset. So if you have a family trust, the sort of investments you can have are things like unit trust, but you have to understand the income tax within that unit trust. When the trust is the owner, it's a little bit higher, because the natural person, the capital gains is always sweeter because of that 40,000 Rand exclusion and the 40% inclusion rate. What I like for trust, though, is endowments, right? Again, the content of this video is not financial advice. That's something for you to explore with your advisor on how you can use endowments within your trust. Okay, cool. All right, my last question for today. If you don't have any more, then we can round it up. What happens if I over contribute to my RA? I think very few people have this problem. So you can't take all your income and dump it into your RA and get the various tax benefits. First, we got to understand the tax benefits. Firstly, when you contribute to an RA or pension, your contribution to the pension is tax deductible. Your employer's pension contribution, that is taxed as a fringe benefit on your side. Okay, so firstly, it makes your income tax deductible. So if you earn R1,000,000, you have the ability to contribute 27.5% of that into traditional retirement products like an RA or pension. So instead of being taxed on R1,000,000, and if you max out that 27.5% contribution, you'll be taxed on 725, which is great because you're literally jumping tax brackets, like lower now. You're paying less taxes, which are great. What you also do is you kind of bump up your rebate in the next tax cycle when it comes to receiving some rebate from SARS, which is quite nice. All right. So those are the tax benefits that you get. Although you get those benefits, an RA or pension are not a tax-free product. It's a tax-deferred product, because should you choose to withdraw your one-third portion in that retirement annuity, you'll be taxed on a sliding scale. But you can avoid those taxes by pushing more into your two-thirds portion that goes into an annuity. Right. So coming back to the question, what happens to you when you over contribute? So once you contribute more than 27.5%, you're not penalized. You just don't enjoy the full tax benefit. So if you contributed 30% of your income, the maximum tax benefit you'll get is a 27.5% deduction or tax deductibility on that contribution. So what happens, it kind of rolls over. SARS is keeping track of this. And then when it comes time to retire, now you can tap into all of this contribution that goes into the annuity portion. All of that is tax-free. So maybe for the first 6 months, or depending on how much you over contribute, you don't lose that money. Maybe in your first couple of years, if you play it smartly, first 3, 4, 5 years, you can have tax-free income by over contributing. All right, so that's how you can use that to your benefit. So you don't lose out from over contributing to your RA. You do get the benefit, you just have to wait for it, right? So with retirement products, there's different kind of benefits: pre-retirement, at the point of retirement, and post-retirement as well. And paying taxes post-retirement is a very painful thing. And as much as you can keep your taxes down, you should. And using that retirement stacking strategy that I spoke about, you're looking at your tax reinvestment and your endowment is a great way to do that. What kind of tax efficient investments can one look at after exhausting your tax reinvestment and your RA? Right, you can look at unit trusts. Unit trusts are great, very, very versatile, because you don't have to have a straight debit order on that. As and when you have funds, you can put it in. You can have a debit order and still put in funds as and when. But what's nice within that, the strategies that you can have within that is limitless, because you can have one You can have one unit trust only focusing offshore. You can have another unit trust only focusing bonds. You can have another unit trust only focusing on commodities, right? There's tons of strategies and lots of solutions. You can even have a hedge fund within a unit trust as well, as opposed to going direct with the hedge fund. Benefit of having a hedge fund within a unit trust is because hedge funds don't speak to you if you have less than $1 million to invest, right? They're complete snobs and they will not talk to you, but you can get the benefit of a hedge fund within a unit trust. So lots of options. If you tapped out on your RA and your tax-free investment, look at unit trusts, look at offshore unit trusts, offshore endowments. Um, there's lots of products. Structures are really nice. Structures, guaranteed structures are really nice, very popular. We've been very busy with that the entire year. In fact, we have a nice 100% protection structure now where you can literally can't lose your money. Doesn't get any easier than that. You just put it in there, forget about it. If the market crashes, great, you lose nothing, but all the reason to gain. How can you minimize taxation on investments? One, you got to understand asset classes. You have to have an investment strategy that an advisor can help you with. Each investment wrapper has different tax rules that you got to understand and strategize on. And again, if you don't want to do it yourself, then you speak to an advisor. All right, so if there's no more questions for tonight, that's it. I'll give you a couple of minutes to let me know if you have any questions. Not many questions from Instagram today. Okay. All right, no questions there. Hold on a second. Before I answer that. All right, cool. What would be the exact process of investing in a single house? Well, investing in a house, you'd have to go through the regular buying, purchasing process, going and purchasing a house. And if you're doing it for investment purposes, you just buy it and you put tenants in there, and that's it. However, if you want to scale that, you don't want to buy property on your own name. You want to have some shields in place because you want to shield from tax. You want to get deductions, and you want to amass a huge portfolio. Mostly people that want to build a legacy that are doing this. And you don't want to have all of this in your name, right? So that here you want to utilize trusts, you want to utilize the business structure in setting all of this up. You want to utilize loan accounts, you want to utilize loan account protections. Again, strategies that a financial advisor can help you with. All right, cool. If there's no more questions for this evening, thanks for joining. If you want to have, if you have any more questions, you can drop it in. You can DM me, and when we have our next session, I'll be sure to bring it up. All right, you guys have a good night, and hopefully I'll see you in 2026. Come on, sir. Thanks for your time as well. Thanks for watching.